Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, we will be looking at a very recent short that was posted as I'm recording this video. This short was literally posted less than 5 minutes ago. So if you haven't seen it, make sure to go and check it out. And in this video, we are going to be breaking down the same 1 to 40 USDCAD scenario in a lot more detail, both from a technical standpoint and a trade management standpoint. But before we get into it, let's quickly refresh our knowledge about redistributions and talk about some factors that help you trade them. I don't necessarily have to go through this again. Hopefully by now through other videos, you know that a drop-based drop is the exact same thing as a redistribution. On high time frame, you see drop-based drop, lower time frame redistribution, and a redistribution is an accumulation leading to a distribution. So it looks like an accumulation and has the accumulation behaviors at the beginning, and then it changes to upside manipulations, or it starts to respect levels of supply within the range before breaking structure to the downside. And exactly the same for a reaccumulation as well, or a base rally on the higher time frames is the same as a reaccumulation on the lower time frames, and it's a distribution leading to an accumulation. So from a distribution looking behavior to downside manipulations and respecting levels of demand. Well, we already know this, so let's move past it. I want to talk about some factors that help you trade them before we get into the actual breakdown. There are many different scenarios for these Wyckoff schematics, so instead of us trying to memorize all of these schematics, let's actually know what we need to pay attention to try and see if a range is an accumulation or a distribution. There are many different scenarios that can happen. It can look like many different things, but generally speaking, as I said in the previous point, a redistribution after an accumulation looking behavior, it either switches to upside liquidity capture, so manipulation of the highs and breaks of structure to the downside, and or it's going to respect the supply levels that are going to be created within the range. So let's just take this drawing as a quick example. You can see that as you're looking at this, you are seeing some levels of respect of certain supply levels at the top, but in the same range you are seeing, for example, upside liquidity capture of these middle points. The same thing over here as well. You are seeing respect of the supply levels, but you are seeing upside liquidity capture quickly showing you another smaller distribution is being created. Sometimes it just completes the accumulation looking behavior and continues to create a much nicer distribution looking behavior at the top, and that would in a way be that manipulation of the highs that we are talking about, or this accumulation looking behavior turning into a distribution. If I see scenarios like this where it's turning to a distribution and manipulating the highs, then oftentimes you have to wait for a couple breaks of structures before you trade them. You end up trading the mitigations of the final distributions that are being created. But in some scenarios, as I said, it's just going to be respecting the supply levels that are being created within the range. So in these scenarios, you indeed are able to actually trade it within the range of that redistribution and take that trade to the downside. There are many factors that you should be paying attention to as you're trading this to try and see if the scenario that you're looking at is actually tradable and is actually valid. These factors would be time of day, so session opens. So what happened after Frankfurt Open? What happened after London Open? What happened after New York Open in relation to this range that you're looking at? When you see the trade breakdown later, you will see how much I'm paying attention to session opens and what takes place after them. Higher time frame analysis is also another factor that obviously helps a lot with knowing our direction, whether or not we're trading, for example, an accumulation or a distribution. Because if you know your higher time frame direction and you know the market has room on the higher time frames to go in that direction, let's say that direction is bearish, then there's probably a higher chance of this range being a redistribution rather than an accumulation. It could still be an accumulation. It could come back up, mitigate certain levels, and then go back down, but there's probably a slight higher probability of that market creating more supply levels to continue to satisfy the high time frame bias. Another factor that helps a lot with knowing your direction in a consolidating market is smaller levels of distribution or accumulation in the same range. Because at the end of the day, the markets are fractal. So if you are seeing a whole distribution or redistribution play out, there are going to be many smaller accumulations to sponsor the price higher within the same range, and many smaller distributions to sponsor the price lower in the same range. The relationship between these smaller levels of distribution or accumulation will oftentimes give you clarity on whether you should be buying it or selling it. In other words, this is paying attention to if supply or demand is being respected in the range. If supply is in power and is in control, or if it's demand in power and in control. Because if you have an accumulation level that keeps getting respected over and over again with successful mitigations of it, all of them resulting in new highs, versus a distribution that's not doing the same, then the range is probably going to be an accumulation range. There are more factors that you can pay attention to, but I don't want to keep you here looking at this random thing that I've drawn on the screen. I want to actually get into the breakdown of that 1 to 40 scenario properly, so you can actually see those factors in action. You can see different chart examples as to how we would approach them and how we would trade them. So without further ado, let's go ahead and break down this 1 to 40 UCAD scenario. And again, if you haven't seen the short, make sure to go and check it out. Okay, so let's break down this US dollar Canadian dollar over a 1 to 40 risk to reward scenario in a little bit more detail. We are currently in replay mode just so I can access the lower time frame data points a little bit easier. And hopefully a big takeaway from this video for you would be how you can actually trade redistributions, or in fact reaccumulations, but in this case redistributions, as they are forming. Truth be told, this isn't exactly what we do all the time. We don't necessarily trade every single redistribution or reaccumulation as it's forming. Sometimes we trade mitigations. In fact, a lot of the times we trade mitigations of it, but from time to time you'll come across reaccumulations or redistributions that the price delivery is extremely clean and you're easily able to take the trade based on those levels. So first things first, I want to start with slightly higher time frame. Let's start on the hourly time frame and see what actually was going on before we go into that entry. This was the behavior that was observed on the hourly time frame, and I don't think I need to break it down because it's extremely obvious that, you know, we had an element of break of structure to the downside over here. We had distribution looking behavior throughout this entire range, creating a lot of upside liquidity, grabbing it, these kind of fake breaks of structure to the downside. I call it fake break of structure because it's still respecting demand levels and more upside liquidity capture. You know, the behavior even on the hourly time frame was pointing towards a bearish market. And especially as these final couple points were being created, this final push to the upside that we had over here on the hourly time frame that manipulated the previous high, and it didn't just do that. It actually filled in all of the inefficiencies that we had over there, all of the imbalances that were being formed over there, and in a way came all the way back up to mitigate this slow moving range, which was the previous supply being introduced to sponsor the price moving lower. Now, one thing to take into consideration is our entry in this case was a mid-range entry. As you can see, the entry was taken alongside of this redistribution forming, but normally we would like to catch the entry slightly higher. So in this case, normally I would want the market to give us a little bit deeper pullback to the upside, come and mitigate the highest levels of supply, because that gives us the best opportunities oftentimes for better risk rewards as well. So this is what I mean when I say we don't always trade the redistribution or reaccumulation as it's forming. It depends on what the market gives us. We trade what we see, not what we want to see, if that makes sense. So I wanted the price to come up there to mitigate that, but I'm not going to trade what I want to see. I'm going to trade what the market gives me, and I'm going to stay adaptable to the ranges that are being created. So now that you know the hourly behavior, now that you know on the hourly time frame we did have elements of breaker structure to the downside and this huge distribution forming there, we can straight away jump down to 5 minutes and below. I'm going to put it on the 4-minute time frame to start off with, because the initial point of interest that we identified was indeed on the 4-minute time frame. This ended up being extended more into a swing position, but realistically this could have been easily closed at a 1 to 10. Indeed, partials were actually closed at a 1 to 10 for this trade as well. So for these quick trades that you're trying to take on an intraday basis, you don't necessarily need to follow that hourly behavior how we were following it before. So let's go through the information you heard on the short in a little bit more detail. First, we spoke about that New York supply that was being created at the top over there from the previous day. So that's a 1 p.m. mark UK time over there. So UK time, New York is going to open at 1 p.m. And you can see something must have taken place in New York for us to get two mitigations like this and a successful market delivering the price below the previous low. From that New York distribution over there, we eventually ended up extending the price all the way down here, and this indeed was with the help of the Asian session as well. But nonetheless, the initial supply was being introduced at the top from the New York session. So now you have your range. When you're looking at the lower time frames, it's important to identify the range and know what range you are trading based on. I had my supply introduction at New York at the top over there, and that's the relative low. So this is the range that we are trading, which means there's going to be trends within this range. There's going to be liquidity within this range. That all of that can be manipulated. It can, go up and go down and do whatever it wants within this range. But this is going to be the range that we focus on. So if we ended up breaking above these New York supply levels, then that's when we should be looking at slightly higher entries over there. So it goes without saying, throughout the Asian session, I normally don't trade. I'm normally sleeping at these times, so I didn't actually watch any of this behavior. behavior until next morning after London session open. Throughout Asia, we sponsored the price all the way back up, manipulated this mid-range structure point over here, manipulated this mid-range liquidity, whatever you want to call it, but still stayed respectful of the range of that supply from the previous day, of the high of that supply. We stayed respectful to that. So we are technically still respecting the whole range, which means if we don't break that, we can consider sell positions based on somewhere over here as long as we have other confirmations. Let's speak a bit about the Frankfurt and London behavior as well. This first dotted line is 7 a.m. UK time, which is Frankfurt open, and the second one is 8 a.m. UK time, which is London open. So Frankfurt open here and London open here. Frankfurt opened, it actually struggled to create a new low compared to the previous low that was created after the Asian Open or at the Asian Open. Normally this means one of two things. Either we are not going to break that level at all, so this is going to be a full-on reversal level and you'll start to be able to kind of trade buy positions to the upside from here, or it simply means the market needs to travel back to unmitigated levels of supply at the top, or even if there is a mitigated level of supply at the top, it could simply be traveling back to those levels to recharge the supply to get ready for the major move to the downside. This is what I want you to pay attention to. Why was I not looking at buy positions over here? Because of the hourly behavior, because of everything that we spoke about over here, from the New York supply, creating a new low, mitigating it, all of these things, right? And as this is forming, you're starting to see, okay, this is either an accumulation and I'm going to be wrong in my trade. Eventually it will fly up. Okay, whatever, I'll take a loss. Or indeed, it's the redistribution that we are analyzing. So we can easily, take advantage of the sell positions to the downside. So the fact that Frankfurt didn't actually break that low, or London started to sponsor the price higher, within itself, it wasn't direction defining for me to tell myself I need to now be looking at the bullish side of USDCAD. But it's important to pay a bit more attention as to what started to take place after these two session opens. So we didn't break that low, but what else is happening? It was beautiful to see London open here at 8 a.m. and sponsor the price up, only to create some more upside liquidity with that previous high over there. We had a previous high, sponsored the price below, London sponsored the price higher and created equal highs with that previous high. So that's factor number one. I'm going to speak about the 1 minute point of interest in a bit as well. But that's factor number one. We're creating upside liquidity in this case, literally right at or below this level of supply. That level of supply which manipulated the previous high and mitigated that New York supply, right? So what is that telling you? In a way, it's kind of getting ready to grab some upside liquidity and mitigate the supply to hopefully get ready for the bearish move. Now let's jump down quickly to the 1 minute time frame before I continue the analysis, so I can kind of discuss the 1 minute entry with you and why I was looking at that 1 minute entry. And you have probably seen the trading view screenshots already if you've watched the short. So you've seen this 1 minute screenshot over here with the entry and stop loss, and this 1 to 10 partials where we close the partials off the table. But let's speak about that 1 minute candle in a little bit more detail. Here's what I want you to pay attention to, because you may be looking at this and asking yourself, how did you spot this one candle? Why did you not take the entries a little bit further up? You could have. I knew that if I am to take my entry at this level, there is a slight chance the market can push slightly higher into the body of this 1 minute candle, for example, before reversal. I was okay for that risk. I was okay to take that risk and say to myself, it's absolutely fine for me to take a loss over here, and if so, I can wait for the behavior to complete at the higher levels, and upon some minor breaks of structure, I'll get in on some re-entries and make my money back. But from a technical standpoint, that 1 minute candle was actually a pretty nice level to want to trade based on. The reason behind that is this was the previous mid-range high that we were talking about, so New York supply and the mid-range high, the mid-range liquidity that was grabbed over there. Have a look at what took place just before the price was sponsored to actually take that high. This in itself, this rally-based rally, this area of demand, in a way is a redistribution as well, right? It is literally a redistribution. On higher time frames, you see a rally-based rally. On lower time frames, you see a re-accumulation. Sorry, if I said a redistribution, I meant a re-accumulation. Obviously, it's not a redistribution if it's going up. So this is obviously a re-accumulation sponsoring the price higher. It was really interesting to see as the market coming back down, how it interacted with this re-accumulation. This was the final level of demand that the market needed to introduce to sponsor the price to manipulate that high. As it started to come back to these rally-based rallies, as it started to come back to these levels, it initially mitigated it and started to round off, started to go higher until it created this 1 minute candle, pushing the price higher before reversing it, but leaving that unmitigated. You can even see imbalances straight after it. I don't necessarily trade based on imbalances, but it's one of the factors that, helps the analysis. It's one of the factors that confirms a little bit more that, okay, the candle that you're looking at is a very nice candle to actually focus on. So the reason that 1 minute candle was chosen was because of the interaction of this price wanting to be delivered to the downside with the highest level of demand over here. It touched it, it bounced up a little bit. Sometimes you will see this comes up a lot more. It even within its own range mitigates the highest level, creates another candle, then drops. So these levels become really good levels of entry, provided we still get decent price action as we are approaching it. I hope that kind of makes sense as to why this 1 minute candle specifically was chosen over there. I'm just going to go back to the 4 minute time frame where we initially identified the entire range of supply. By now you have obviously seen that 4 minute candle as well, so that was a 4 minute candle. So we knew somewhere within this range we're going to get mitigations. With a bit more analysis we could limit that to the 1 minute range. Now after the equal highs were created over there, as the market started to reverse and approach those equal highs and approach that 1 minute area that was identified, this is a beautiful price delivery to be able to see as it's coming up to your level of entry, or as it's coming up to a level of supply. Literal slowdown, distribution looking behavior. It's very, very, very nice to see this. This is literally screaming that the institutions are getting ready. Orders are being created, most likely on the sell side over here, because of all of the factors that we were mentioning. Remember, the game of trading, the only factor that you can control is your risk. So naturally, we want to take trades that are high possibility trades and manage our risk properly with them. So it's all about probabilities. In this case, the probability of this trade being on the bearish side was much higher than the bullish side because of all of the factors that we saw. And especially also because of this slowdown as it started to come up, this distribution looking behavior. If you want to zoom out a little bit more, technically speaking, this whole thing can even be identified as a distribution. Remember what we spoke about time ago about distributions. It likes to create upside liquidity and grab the upside liquidity before reversal. It also came to entry at a very good time of day, around 12 p.m. UK time. So that's an hour before New York open, which means we are trading at a time of day where there is a lot of liquidity, and within an hour there will be even more liquidity introduced into the market, even more liquidity and volatility introduced to the market. Let's jump down to the 2 minute time frame very quickly so I can show you why this first level over here was identified as a potential demand, where before that we need to be hitting some good risk to rewards for us to close some partials before it reaches that level. This is the 2 minute area that we are highlighting over here. I just want you to have a look at that candle and the time of day. It's very simple now to put 2 and 2 together. Obviously we have the final sell before buy candle pushing the price lower into this low, still struggling to actually break that low, and then a full-on reversal to the upside over there. So technically speaking, that in itself is a candle that has not yet been mitigated, which means the market can come, tap off this candle and give us some reversals at least to the upside, maybe even full reversals. So as I'm taking this trade, I kind of need to make sure before we come into these candles, I'm floating decent enough in profit for me to be able to actually close a portion of my trades. So before then, we are already hitting 1 to 10s. And as I have mentioned in other videos, in the previous long video as well, you need to be closing a lot of positions off the table at 1 to 10 if you want to be an intraday trader. It's a phenomenal risk to reward to hit within a few hours of trading. How long was this? To give us 1 to 10 from that entry to over there. We're looking at less than an hour that you're hitting your 1 to 10 over there, right? So obviously you're going to be taking a big position off the table. For me at that 1 to 10, around 50% was taken off. So although this whole trade got extended to 1 to 40, of course I'm not going to be keeping my entire position running until 1 to 40. So as it started to approach that 2 minute mark where we knew obviously we could see some reversals over there, we should be securing some profit. It didn't even react off it. It instantly just broke that 2 minute mark to the downside. But remember, it's still not creating a new low compared with this Asian low before. So let me just highlight this and we can extend this line further over there. So although it invalidated that 2 minute mark that we highlighted, it still hadn't created a new low. So how do we know? Should we keep the trade open? Should we close the entire trade? This was very close to New York open as it started to invalidate that level. So I decided to just pay attention to what's going to take place throughout New York. Let me just bring this back a little bit so we can kind of see the price delivery a little bit easier as we zoom in. This dotted mark over here is the New York open on that day. And the behavior that was seen over here was all I needed to know. You need to keep your trades open. New York opened. First, we got an initial push to the upside from New York. As soon as it opened, you see we got a push to the upside over here. But instantly, it reversed back down. And now it has created a new low compared with that Asian low. So what am I seeing now? I'm seeing that whole redistribution. Paying attention to minor details for me to be able to trade within the redistribution. And I want to highlight again that this is not something that we do all the time. I don't don't do this all the time, but obviously if I'm seeing clean scenarios like this, it makes sense for us to actually trade that redistribution. So New York delivered the price below the Asian low. Now we're seeing that redistribution actually play out. We're seeing that supply and the mitigation of that supply and the secondary mitigation of that as well, resulting in a new low. This is now very similar to what we spoke about before. Now we have a New York supply level over there. So again, this market pulled back and mitigated that New York supply. This in itself could have been re-entry opportunities. Maybe some people even did trade this to the downside, because this would have in itself been amazing trades to the downside from here for an intraday play, and from there on it just started to create lower and lower and lower and lower points. Now, where was the secondary point of profit? Why was a lot of the positions closed at that 1 to 40 mark? It was a little bit over 1 to 40 by the time I closed it. To be fair, it instantly came down and invalidated the level of demand that I was looking at, but it gave us the general reversal anyway. So let's go to the 5-minute time frame so I can speak about this level of demand over here and why this was very, very important. So when we were focused on the hourly time frame before, we spoke about this manipulation to the upside, we spoke about all of these things, but what actually sponsored this move, this final move to the upside to actually manipulate that high? Clearly you can see a period of slowdown over here that started to create demand, started to create orders to sponsor the price above. Naturally, it's practically one of two places that this move originated from. It's either the very low or levels of reaccumulation as it's going higher and higher and higher. And that level was indeed one of the levels of accumulation. So in itself, that's demand. In itself, that's where demand was being introduced. And you pay a little bit more attention to actually what took place in that range. You can see many mitigations. You can also see manipulation to the downside, whether it be equal lows, whether it be trend lines. And you can also see a tiny final level of slowdown over here, which ended up creating a final rally-based rally, or a final, let's say, drop-based rally, whatever you want to call it. On the lower time frame, this is practically another accumulation that sponsored the price from here up. So it goes without saying, when I see something like that and when I see that that level is not mitigated, I ask myself, what's my risk reward down to that level? 1 to 40. Okay, amazing. I'm just going to close 100% of my position before or as it's reaching that level. I just thought it was important to quickly mention that, because obviously on the short you saw a screenshot of the entry and of the exit of that trade as well at 1.27035. So I just wanted you to have an idea as to why that was where the final positions were closed. You know what's really interesting when you pay attention to this entire trade? You realize that as we traded this redistribution to the downside over here, later on it created another phase of redistribution, which was also very easy to catch and trade this to the downside for more intraday trades. I didn't do this. This was not a trade that I executed. I want to make that extremely clear, but I just want to highlight a few factors so you can see how easy this would have been to trade as well. Obviously, we spoke about the New York supply before that, right? On the lower time frames, we had the New York supply, we had the mitigation of that New York supply, and all of these are resulting in new lows in the market. And remember, a redistribution is oftentimes the behavior of an accumulation followed by behavior of a distribution. As it started to develop more and more and more throughout the Asian session, just before the Frankfurt Open, you were able to see these manipulation of these highs over here, manipulating these highs, manipulating even these highs being created, but staying respectful of, again, whatever supply that we have at the top over there. It obviously has mitigated the New York supply already, but let's have a quick look at the 10-minute time frame. You can see this 10-minute candle, very strong candle, pushing up before reversal. So although this market came back up to mitigate that same level of supply over there, it had another job. It had to manipulate the highs, and it stayed respectful of that level of supply. So when you're able to now see this and the subsequent move to the downside, which is now in a way confirming that, hey, that's your relative break of structure to the downside, then it goes without saying, entry after that is not the most difficult thing. Now you've seen the behavior from before, you've seen the behavior from hourly. We literally spoke so much about this redistribution over here. So hopefully you can now see similar stuff that, hey, you know, over here, we also had upside liquidity capture. We had the break of structure to the downside, and upon these pullbacks you would have either entered it at the top over there, or as you could see, there was other entry opportunities as well, such as the mitigation of this, you know, very obvious looking 5-minute candle that's being created in the middle of the range over here. But as I said, this second redistribution wasn't a trade that I actually took. It's a lot easier for us to look back on the charts and be like, oh, I would have traded here, or this, you should have traded there, and this and that. So I don't want this to necessarily be the focus. I didn't actually trade this. I just wanted to quickly speak about how you could have traded this as well. But this first position, I hope now it's starting to make a little bit more sense. And by the way, for anyone wondering if these retracements here were in a way scaring me to close my trades, what I just described to you in terms of that New York supply and this redistribution over here was the exact reason why these retracements were not scary. In fact, you can see on the 5-minute time frame this clean candle being formed over here. So it goes without saying, from these lows, it can easily retrace even all the way back up to mitigate that 5-minute candle, and we can still be okay to hold these trades open. Obviously, in that case, it doesn't really make sense to keep your trade open and wait for that mitigation and then keep it open as it's coming back down. It just makes sense to quickly take your profits over here and get ready for secondary trades over there, but that didn't even happen. It ended up going down, it ended up smashing through our targets, but ultimately, this is what's interesting. Ultimately, it did indeed stay respectful of that level of accumulation, not that specific level that we highlighted for the exact level that we wanted to get out, but that whole range. It ended up staying respectful of that and giving us a retracement back up, which, if I'm not mistaken, ended up mitigating the highs. Let's go back to the hourly time frame. Yeah, it ended up mitigating the highest levels over here before coming back down. So you can even see that as I was speaking about the ideal entries being at the top over there, we didn't get those ideal entries there and then, but later on they would have been entry opportunities. Truth be told, I wasn't even looking at USDCAD on these days for me to want to actually take the trade at that level. I didn't. That was the position that I took advantage of. So I hope this breakdown made a little bit more sense as to why that trade was taken. Now I just need to highlight something extremely important. I did say this in the previous video as well, that we don't have to glorify these high risk rewards for ourselves. It's nice to catch these high risk rewards, but even if you had an entry just based on this 4-minute range, so you put your entry below over there and your stop above, you're looking at maybe a 12 pip stop loss over there, but you are still walking away with a 1 to 10. This move to the downside would have still given you a 1 to 10, right? With the same analysis, with the same second take profit, you would have still walked away with a 1 to 10. So I just want to show the importance of this, that I did so much analysis and walked away with a 1 to 40. Okay, amazing. But it's not necessary, because these consistent 1 to 10s is what will pay you. It's good to have high risk rewards as well, but we don't even necessarily have to go into that much detail with the analysis. You've seen everything before then. You've seen that 4-minute candle. So instead of just waiting so much, you could have the exact same analysis, even wait for this slowdown, but enter based off of that 4-minute range and not necessarily have your stop loss over there. So yeah, I hope that made sense. Let me know in the comments down below if you have any questions, and if you heard anything in this breakdown that you want me to elaborate in a little bit more detail in a future video, also let me know down below. But with that being said, if you got value from the video, make sure to press the like button down below. If you want to get notified when I post more videos and more breakdowns, then please do make sure to subscribe and turn on post notifications. Let's elevate and let's catch some pips.